Welcome to the Currently Powerful podcast. We have Brandon Lorenz with Cedrus Financial. He's a wealth manager and has some excellent life-changing nuggets to share with the average homeowner and how to put all that to work. So, to start off, Brandon, tell us about yourself.
Well, hi, Jackson. Thanks for having me on your show. It is, it's been great just being a friend of yours and getting to talk to, all of your clients and everybody on this podcast. My name is Brandon Lorenz. I work for a local financial firm called Cedrus Financial. And I've been doing this for 5 years. I had a whole nother industry that I was in. But through circumstances, it was a great opportunity to get into something new. And I've always had this fascination about finances, but just like everybody else, sometimes you just don't know the right questions to ask. So getting into this space has just been completely eye-opening in knowing there's a whole other world to financial investing than what you've been taught by your parents, by people that come into your work or your spheres of influence. And there's so many, I wouldn't say better, but there's so many more options that people aren't introduced to and know about. And that's one of the things that we love to do is educate people on exactly what they are, the risks, the rewards, and just give people more tools in their tool belt to utilize, especially when it comes to home ownership.
I love it. So, tell me, what kind of services does your company offer?
So our primary thing is families, right? So we work with a ton of families. We want to be able to provide good financial planning, and that's all aspects of your financial planning. Most of the people, when they talk about, financial advisors, really just think about retirement. And that's just a small piece of the puzzle. Yes, we care about retirement and making sure that we're putting stuff away to retirement, that it's growing, that you can retire one day, and maybe sooner than you really think. But one of the other aspects is really the day-to-day life, cash flow. What people really concerned about is making ends meet day to day and driving some of those bigger decisions that you make. Purchasing a vehicle, maybe remodeling your house, maybe upgrading to a bigger house. We go through all those scenarios, your income, your expenses, your liabilities. We look at estate planning, we look at tax management, we look at investing. Every aspect of your family's financial needs, we help make good decisions with all the information that you have so that you're making those decisions with confidence, that you're not second guessing yourself, and that you have peace and contentment about making that decision and can sleep well at night.
I love that. Yeah. And the funny thing is a lot of people are only thinking, like you said, about the retirement aspect of it. When, if you own a home, there's so much more options available to you than your standard renter who does not have much savings. So with the equity that you have in your house, there's so much that you can do that people don't even think about. It's that work, that money is not doing any work for you at all, but it actually is a real thing that exists, which you can take advantage of. So, even if you're not making a ton of money, but you own a property, you own a home that you bought even 10, 15 years ago, or even really around 2000 or older is really a good time because you should have a good amount of equity into that property. And there's so many things you can do. Now, one of the things that I realized is that, you know, being a real estate agent, being a realtor, most people want to move, but they're stuck in that 2% or 3% interest rate on their primary home. And they're really sick of it, but they just can't bring themselves to get rid of that rate because it's like, oh, I'm only paying 2%, so why would I get rid of it? In the meantime, they have, 200, 300, $400,000 in equity just sitting there doing nothing at all. And that's really their money that they could do something with. Now, one of the things that people say to me about their situation is, I'm sick of this house, and you know what? Eventually, I'm thinking I will rent out this house that I'm living in and get a new one. And that way, at least I'm still keeping that 2% or 2.5% rate. And then I'm still making some kind of money. Another one that people talk about is just to stay in the house. I'm miserable. I hate it. It's too small or too big, whatever, but I can't give up this rate. And so I'm just going to be miserable and stay here. But there's better ways.
Mhm.
And, me and you have talked about it quite a bit. And a lot of my clients have the same exact questions and the same exact thought process. So tell us a better way to go about dealing with this 2% interest rate, 3% interest rate, and switching potentially to like a 7%. And how can we still win out of that?
Yeah, it's a scary thought of, having that sure thing, which a lot of people refinanced their house in 2000, 2001, to these really low interest rates. And, the thought of giving that up is a real hindrance to a lot of people. And they just can't imagine ever going up to 6%, 7% interest rate, when that used to be the norm back in the day. One of the things that most people are stuck with is really that interest rate number. And just like you were saying earlier, the biggest, I think, potential that most people are giving up is that equity in their house. It's one of those things that if your primary goal is to live debt free and to have the house paid off, and that's what makes you sleep well at night, that's fantastic. Go for that dream. But if that is not the primary goal, and if a house is too small, too big, you want to upsize, downsize, maybe your family is growing, you need more bedrooms, and don't know where to put that in your current house, the idea of, well, I'm paying 2%, my mortgage is manageable right now, and I can't imagine, a 7% interest rate on top of a bigger home, and maybe a bigger um, a home that costs more than your current house. So one of the things that we really do inside financial planning, and your financial planner should be doing this with you. If they're not, I would say go find one that can really model out some of this stuff and give you some confidence to be able to do it. One of the things that we look at, and it kind of even goes towards people that want to, make extra payments on their mortgage, we'd probably say it's not the best place to put it. It's one of those things that, yes, compared to keeping money in a bank account, whether it's, Chase or Wells Fargo or anywhere else, when you're making no interest on it, well, it is a better idea, even at 2%, 3%, to pay down that mortgage. But though, one of the things that most people don't think about is, well, are there better things that I can invest in that actually make more than my interest rate, that can help build my net worth in the long run? And really, that's one of the things that is the biggest consideration. And Jixon, you and I have talked about this many times, is, well, I have $400,000 of equity in this house. It's a $600,000 house. How in the world, if I go from a $600,000 house that I have mostly paid off, my, mortgage payments pretty reasonable, $1,700, $2,000 a month, and go buy a $800,000 house, which may be the price point you need to get at to, have that third, fourth bedroom for an expanding family, or just the type of house that you really want to, that forever house, that dream house that you really want. And all of a sudden you have a, $800,000 house. Maybe you put, 20% down. Maybe you're thinking about putting all of your money that you have had saved up in your current house into that house. Um, most people are thinking along those ways. There's so much better ways of thinking about it, that is really going to turn kind of this world, this industry upside down. Because most people are thinking, well, man, if I get an $800,000 house and I put 20% down, I'm going to have this massive mortgage, that's 640,000 dollar mortgage at 7%. you're talking in the neighborhood of taxes, insurance, and everything else, paying upwards to $5,000 a month. Well, how can I go from 5,000, $2,000 a month in your current mortgage to 5,000? I can't handle that. We're already stretched thin as it is. Um, but one of the things that we look at is, yes, you may put $160,000 into that house, but you've pulled back some of that equity from your current house, and you have this, really, if it was a $400,000 profit from your house, maybe 160 goes into your new house. Well, you have $240,000 that can really go and do something. This is the part where most people would think, well, I'll just put it into my next house. And that's really, yes, you can do that, but there's better ways of looking at it. One of the things, if you can go and invest it, which sometimes investing money in this world can feel very, spooky, especially in the last 18 days with the market volatility. I mean, we had some high highs and low lows, and people are like, I just can't risk my money like that. Well, there are products out there. There are, products that have great return, that like volatility in the market, that have downside protection. And, that may be a separate conversation in the investing world, but there are things out there that as long as you can go get 1 or 2% more than your mortgage, you're really kind of come out in the end better at the end of that 30-year mortgage, that 15-year mortgage, with a higher net worth than either just putting money in or even keeping that house. So there are other options that we can get into.
Yeah, so tell us about those options because if you're paying 6% on your or 6 or 7%, let's say just go for 7% on your new property, what's something currently that somebody can do with that additional $160,000, or sorry, what is it, $250,000? Yeah, what can they do with that 250 grand that will bring them returns that'll help them with that monthly payment to help reduce that cost?
Yeah, most people would think, well, $260,000, if I had that, I don't want to risk that. I'm just going to put that in the bank. Well, if you put that in the bank, or even a high interest savings account these days, those are tied to interest rates. The best that you're going to probably get is somewhere in the 4 to 4.5%
4%.
interest
Hmm.
rate right now. As the interest rates come down, what you get at those banks is going to come down as well. But one of the things that we look at is if you put all that money into the house, well, that money would be tied up for 30 years as well. So, we can't think of it from a short-term perspective. We have to look at it from the long term. And for us, the long term, maybe 2 years, 3 years, 5 years. Because some of the stuff that, Jackson, you and I have been talking about is a product called a structured income note. There's a lot of other different ways to look at it. That's one thing that we like to talk about. And it's one of those things I would never advise you to do anything without going to talk to a professional, see all the risks that come with it. There's a lot of rewards, but there are some risks involved, and we want to make sure that you're comfortable doing it. But
I just
we
did it with you. So, I mean, I feel very comfortable with the minimal amount of risk really that we're taking and the
Yeah,
return
there are
being.
some products out there that, really have some downside protections, and if you manage it correctly, can be a huge benefit for you. One of the big gaps, is obviously that mortgage payment going from 2,000 to, nearly 5,000. Difference in that mortgage payment is a huge, is huge, and if you don't have the cash flow to be able to cover that, well, that's really where that $260,000 can go to work for you, cover that difference to where really your out-of-pocket difference is negligible from your current house. So how do you do that? Well, in order to make up that gap, well, you really need that money to go, not make only, really zero at the bank, or even a high interest account or a money market account that's getting 3 or 4%. Well, that's not really even enough to cover the gap from the mortgage. You really need something that's going to go get, 9, 10, 11, 12%. Well, that's where you think, well, what products are out there that can go get that? These structured income notes with its, risks and those kind of things they are an acceptable way to go and get that type of return from a bank by utilizing that extra capital that you have. If you can go get 10%, a net 10% from your investments year over year that pay out on a monthly basis, well, that really is, that's an extra $26,000 that $260,000 is really providing that allows for that capital investment to not decrease, but give you enough cash flow to be able to cover that difference in that mortgage payment. And obviously, if you can go make a little bit more on it, you can get to the point where you're actually making money from that investment than losing from it. The other thing too, that interest rate, let's say you have to get one that's 6.5, or 7%, the likelihood that that is going to be that high for forever is really, probably not the case. At some point, we're probably going to see some lower interest rates, and you can either recast that loan or you can refinance that loan. So when you're looking at the duration of a 30-year loan, we may say, yes, you might be paying 6, 6.5, or 7 now, but they may not be for forever. You just never know. In a couple of years, maybe it's 2 years, 3 years, 4 years down the road. Yeah, maybe we may not get down to 2% anymore, but we might be able to get to, 5%, 4%, something that's really quite manageable. And at that point, you're really going to be happy that you made that move, refinance that house, get that mortgage payment down. And then as you drop that mortgage payment down, if you're still making that 10%, 11% on that money, well, less of that has to go to that mortgage, and you can start building your net worth as well. There's this idea of arbitrage too, Jackson, that most people don't think about. If you own a $600,000 house, well, that $600,000 house is only going to appreciate at a certain rate, right? But if you upgrade to an $800,000 house and only spend $160,000 as down payment to get into it, well, that $160,000, the $800,000 house is growing at the same rate. That's that $600,000 house. If it grows at 5% a year or 4% a year in its value, well, that $800,000 house is actually growing from a dollar for dollar perspective at a much higher rate. And still, at the end of the 30 years, you're going to own the same house, but you're going to own a house that has a much higher value than your previous house had.
Yeah, that's wonderful. And with these structured income notes, like for example, the one that I just picked up with you a few days ago, the volatility is really good for something like that, where we're getting monthly payments from this note at a much higher rate than even 10, 11%. So tell us more about how that whole thing works out, and how can that benefit me if instead of using it for my retirement income, I was to use it for the upgrade of my house.
Yeah, so there's a lot of inner workings to these structured investments. And again, I'm going to reiterate, go talk to a professional before getting into any of these products. But, the recent volatility in the market, we really see that as more opportunities when you have the other products than just sitting in the market, owning the stock market, or being in a bank account. There's plenty of ways for us to utilize kind of the uncertainty in the market. And I'm sure we're going to talk a little bit about some of the uncertainties with tariffs and, what the future might hold. As much as we can see into, that cloudy future, we can utilize some of this uncertainty to really drive some growth. So the way that some of these, products work is when there is more fear in the market, when we see these big up and down swings in the market, more people are usually more I would say fearful or hesitant to get into the market. So a lot of these products, the banks that underwrite these structured notes, they usually tend to have to, entice investors with more interest rate to it. The Jixon, the one we are talking about, with the kind of the same level of protection. And again, there's a lot of nuances to it, but we've happened to be able to utilize the volatility in the market and get an interest rate, or what we call a coupon payment, that is north of 15%. That's not a kind of an everyday occurrence. And it's really, depends on the volatility of the market, but we're going to utilize that as much to our advantage, to our clients' advantage whenever we can.
Yeah, that's wonderful. I mean, to have the initial investment be protected and still have money coming in at north of 15% is incredible. And so something like that, if I hadn't talked to you and, this structured income notes is just a brokerage only product. So as a regular investor, I would never have even found out about it and I could not have used it. Now, let's say if I was ready to have purchased my property and have sold my existing home, and if it was in that right timing, I could have been putting 250 $300,000 into that structured income note, bringing in 15, 16, 17% of coupon, uh, right?
Yeah. I mean, again, it's going to be a little bit of with the timing, and those aren't things that are going to go on perpetually all the time. So you have to, really work with someone to manage all of those uncertainties, both now and the future. But when you can take advantage of some of those opportunities, and they're not going to always be around at those levels. But again, you try to be pretty opportunistic without taking undue risk in order to be able to go, get something that is um, available at a certain time, a point in time. But there's a lot of ways. Maybe you don't time it perfectly to where you're getting something north of 15, but there's usually a pretty good chance that you might be able to get something, 10, 11, 12, that really works and fits into your equation.
Yeah, so it's almost like you can expect, well, not necessarily expect, but generally speaking, it's been right around 10 to 12% is what's been happening
Yeah,
recently.
I mean, a lot of that, it kind of depends on your appetite for how much protection you want. That number varies a great deal. And we definitely can't say that that's going to always be the case, because you just never know how the financial markets are going to play out in the future. And by no means are we guaranteeing any of this stuff. It's one of those things that you can't. But you just have to take a look at the landscape of the financial market, see what's available, make sure it fits into your portfolio, make sure it's something that, some of these things are locked in for a period of time. So it's one of those things that you have to be willing to, be able to have that lead time. If you need that money, 6 months from now or a year from now, it may not be the right product for it. Because, in some cases, if you get out early, there's some penalties to get out early. You might not get all of that money out. So you really need to talk to a professional to see, does it fit into your entire portfolio? And making sure that, one of the things that you never want to do is ever sell in a down market, or panic selling, that kind of stuff. And that's where, working with a professional, if you set up your portfolio the right way, you're never getting out at the wrong time, and hopefully you're getting in on at the right time as well.
Yeah, there's definitely a lot of perks to having somebody else managing your investments.
Yeah,
Take up
sometimes it's just taking the emotional part of it out, right?
yeah.
Is sometimes you're worried about that money, but being able to talk it over with a financial professional and having a plan and making sure that your short-term needs are met, well, we can ride out some of these markets. Or maybe sometimes when there's upheaval in the market, it presents new opportunities to change your investments around, which is what all financial advisors should be looking at, just to make sure that their clients are being served the best they can.
Yeah, that's wonderful news. That's the correct way to go about it instead of just like you said, panic selling and doing things because it feels scary.
Mhm.
Um, but those, like we've seen it before many times where the opportunities are there. Since the stock market has started, it hasn't. Yes, it's gotten downturns here and there, but it's still just going up and up and up. So, as long as you're staying true to the course, and unless the whole thing crashes and burns down, I mean, where else is it going to go? It
Yeah.
might it's just a matter of time and market, not you just not just panicking and leaving when you think things are. And there was something that I read where the people that took out money in 2020, when things started crashing, have still not entered the market, and they've lost on so much money because they were emotionally doing things instead of letting somebody that's a professional actually take care of things. And so in these situations, what I'm hearing and understand is that you have to look at it at the time you're ready to make a move. But more likely than not, the best thing for somebody to do in order to upgrade or downgrade or whatever, if they want to put the equity in their house to good use, is talk to a wealth manager like yourself and take a look at what the actual plan is, what are the options available, and see the best ways to put money to work for you. Because most people, if they bought in 2020 or earlier, they have a lot of equity in their property. So what would you recommend for somebody who is, bought their house in 2020, the house has gone up, say $200,000 in value. What would you recommend for them to do?
Well,
And they
just
want
like
to
you said,
upgrade.
yeah, just like you said, go talk to a professional, and really got to get to a point where you're with the financial advisors that you really trust, that you get along with, that you trust their value, their input, um, and really look at the different scenarios. You really have to look at all the scenarios of, do I put, 20% down, 30% down? Should I put all of the money from my my current house into the new house? Look at all those opportunities and all those options. There's never a one size fit plan for everybody. Everyone is different, so your financial advisor should be able to, take your needs, your expectations, your knowledge of the market, what you're comfortable with from a risk and reward standpoint, be able to put all that into a plan for you to make the best decision possible, and make a decision that you're going to be happy living with, going forward. So, yes, number one, talk to a financial advisor, talk to a financial planner, and just get that all laid out ahead of making that decision. You're going to be so much, um, armed with so much more knowledge and so much more options, and make that decision to upgrade house, downgrade house, whether you're, 20, 30, or if you're entering retirement, making those type of decisions. When it comes to the market, yes, one of the things that we can't look at is just a year to year perspective. We can't ever know exactly what the next year is going to hold. We don't know how, these investments will work. We can never let, one of the sayings is past performance is no indicator of future performance. But we can look at the history of the market to give us a good indication of which way it's going to run, and how these recessions or these pullbacks, how we get into them, how we get out of them, and position yourself the best way you can to navigate those really turbulent waters that we call the stock market, and the financial market. But there are so many opportunities out there. Again, there's no one size fits all for everybody. But go talk to somebody, and usually you're going to come out of that meeting with, no, I want to stay where we're at, or no, I am okay moving forward, even in this, low interest rate to high interest rate decision that you're going to make, and come out with it with the confidence to go do that without second guessing that decision later on.
That's wonderful. So what do you think with all the tariffs and all the changes being done by the government right now? What do you think it's going to do to the financial markets, and what time frame do you think people should be looking at to start making some movements with their retirement income? Is it time for people, with retirement money, if they're getting ready to retire and they have money sitting there that they're just watching it go down, then up, then down again, what do you recommend for those people at this time?
Well, first of all, don't panic sell. That's the last thing we want to do. The other thing too with markets over time, really the industry, the financial markets are driven by, companies that make profits. In the end, companies that make profits, they do well, and that leads to this growing economy. Yes, the tariffs right now are bringing some upheaval into the financial markets because the financial markets really love predictability. Really, they want to know what's going to come up next year, what's going to come up in 2 years. And right now, unfortunately, we don't really even know what's going to happen week to week. So that brings a lot of uncertainty to the market. And when there's uncertainty in the market, that usually drives some fear. And that usually um, it creates uncertainty, which the stock market, the financial institutions, they don't like uncertainty. Um, but it's one of those things, if history is going to tell us anything, that, administrations come and go, policies come and go, and, what seems like upheaval now, tends to iron itself out over time. So if we have a day-to-day mentality in our finances and in our investing, yes, there's a lot of upheaval. But if we are looking, year down the road, 5 years down the road, 10 years down the road, 20 years down the road, or if you're, 30 years old and retirement's, 30 years away, well, we need to have a different perspective of how we look at the current market. And that, this market right now and the uncertainty of this time is probably not going to stay forever. I would say I would be guessing just like anybody else if I said, 6 months, 1 year, 2 years that we're going to be out of this. We just don't know. But what we know is that if we can take the best precautions, get the most protection in the things that we do, have a, long-term focus on, funds that you have that can be long-term, have a short focus on money that you have that needs to be liquid. We can manage this without ever getting into a position to have to exit the market when it's down. And that's where having a little bit of professional help and advice can go a long ways. And yes, I believe that, every person with a dollar in the market should be rethinking how they have the dollar in that market. And talking to your professional or talking to them for the first time and saying, hey, is there a better way to do this? Are we making the necessary changes now to help us in the future? Maybe you're doing exactly what you need to do, or maybe when you really take a look at it, there could be some things that you could do to improve your position.
I kind of look at most things like changing lanes in traffic. Sometimes you're stuck in the left lane, everything's backing, you're just in the very back, and all of a sudden you see the lane in the right is free, and you can just drive all the way to the front. So sometimes you do have to make those changes where it might look like you're losing money right now, but if you're in the right lane, you're just going to fly right up. And one of the things that I always like to say is money is made in change, right? So right now, I feel there's a lot of opportunities where people can make a lot of money if they make the right change and not just stick in that same lane that they've been in. And so
Yeah.
what's your thoughts on that?
Well, it's one of those things that most people can't really envision, especially compounding money, money that's earning interest or money that's growing at a certain growth rate. Most people can, usually see 1 year, 2 years, 3 years down the road. But most people really cannot see, decades down the road. And that's really what your money is doing. Some money that most people have right now, they will not touch for decades. And they need to have this longer term approach to it. When we're thinking about money growing over time, there's this rule of 72. And that's just saying that, let's take 72, divide it by a growth rate that you think that it's going to happen, and it's going to help us determine how fast our money grows over time. So if you can make 7.2% on your money year over year, so 72 divided by 7.2 is 10. Well, every 10 years, you should be able to double your money. And that's really hard for people to grasp. And I usually do this thing where, either young people, old people, working people, retired people, I show them $100 bill. And I go in there and show them $100 bill and say, Jixon, how much is this $100 bill worth? Most
$100.
people, most people would say $100,
All
right?
right.
But it's one of those things. If I said, well, here's $100, how much is this $100 going to be worth in 30 years? Well, if you say, well, we
$30.
use that math in our head, well, in 10 years, this $100 is going to double. It's worth $200. You go another 10 years. Well, that $200 is going to be worth $400. And you go 30 years out, it's going to double again. And that $100 is worth $800. Most people can't see that 30 years down the road with the simple compounding and investments to say, oh, I have $100 right now. I could either go spend it and get $100 worth of something, or I could go save it, and in 30 years, when I really do need that $100, it's actually worth $800. And that's really at $100 example. Well, it's one of those things, maybe you don't have $100 in your pocket to go save. Maybe it's only 50. I would say start with 50. But with some people that have a little bit more, let's say, take that example with $100,000. It's the exact same math, the exact same compounding. You know, your $100,000 right now in 30 years could be worth $800,000 if you don't need that $100,000 now and could use it in retirement someday. Those are the things that most people can't really see beyond, this week's or today's, fast food run or Starbucks money, or even next month's rent, or even next year's insurance bill. Most people can't see past that to see how much money is actually worth in the long term. And that's where a financial professional that can do some modeling for you can really show you and you can really make small tweaks inside either your investments or your returns, but even a 1% difference in your returns over a 30-year span can make massive differences in that investment over that time period.
Well, and that $100, if you stuff it in a in a mattress, or if you were to just put it in your regular savings account that's giving you 0.01%, I mean that's going to be worth what, like $30 by the time you're looking to spend it in 30 years. So it
Yeah.
makes sense to put it in a place where it actually will grow. And so back to that question of somebody who is looking at upgrading their house, they have their $600,000 home, that's your average Colorado home, and they bought it for 200 grand. Now they got 400 grand in equity. What is your opinion on the best way for them to make that. Now, they're in a situation, let's say they're financially stable, upward mobile, a couple or, a family that is in that prime age of 20 to 40, where their income is only going up and they're in that financially stable situation. What would you say is a good way for them to make the upgrade from their $600,000 home to $800,000 home for their growing family? What would be your recommended best way? And yes, we know we got to talk to a professional for each individual way, but given that kind of an example of your average person, what would be the way to go?
Well, there's a lot of ways to do it. But if you came in and sat down with us at Cedrus, we would look at everything that goes into that equation, look for the right investments that we could potentially go get into afterwards. Because it doesn't matter if you upgrade houses and if you have idle money sitting around. If it's not doing anything, if it's sitting at the bank, you're actually losing money due to inflation that's happening all the time, where prices get more expensive, that kind of stuff. So you really have to lay that plan out. So besides that first and most important part of going to talk to a financial professional, for us, we're going to go out and look at all the products out there, something that matches our clients' expectations and needs, and be able to, put it into something that is, has the lowest amount of risk for the best returns that we can. And if we can get those returns to be higher than that interest rate, that new interest rate at 6 or 7%, well, then, we're in a positive situation to where, that difference in that mortgage payment really can be covered through some of those investment gains for sure.
So wonderful. So, for example, if somebody's taking 6% as their new mortgage payment, they put 20% down, put the additional equity of, let's say, if they're buying 800, 160 down, and 240, or what is it, 240? Yeah,
Yeah, 240.
240 to an investment that's bringing them 15%, then they're looking at an upside of 11% of payments that they're going to be getting paid, correct?
It's not quite that easy. We can say that it's that easy. It's not quite that easy with some, ordinary income and some additional taxes in there. So you need to make, there's a margin above that interest rate on the new mortgage that you need to make in order to even just break even. And that's a sliding scale depending on what your interest rate and the payments are. But yes, once you get over that hurdle, those additional dollars, really can go help towards that payment of the mortgage, the extra payment in the mortgage. Or if you can handle that with your current cash flow and your current income, well, then that money can really be set aside and really work a lot harder for that retirement or college education for your kids or a whole host of other things. And that money can just be working a lot harder for you.
So that money that is coming in as interest can be compounded, and you can make even more money on the money you're making and just let it grow and grow and grow.
Yeah, and those are things that, without looking, you really have to look 30 years down the road and be able to look 30 down the years down the road. Because no matter what the mortgage, if you're in a fixed 30-year mortgage and you pay it off in 30 years, whether you're paying 5,000 a month or 2,000 a month, depending on, what mortgage you're in or how much down payment you made, at the end of the 30 years, you're still going to own that house, right? So it's really, you got to look out 30 years and see, well, what did all of the other money do? At the end of the 30 years, based on those investments, whether into the house or in another investment, should be able to give you some comfort knowing that, hey, look at it from a net worth perspective and say, hey, once I do own this house in 30 years, was I better off by putting more money down initially into the house? Or was I better off after 30 years not putting so much more down, having a higher mortgage payment? But you may end up, if done properly, you may actually end up with a higher net worth at the end by taking a bigger mortgage out than you did putting it all into a down payment.
That's wonderful. And you can model all that out at Cedrus, right?
Yeah.
Wonderful. Well, tell everybody about how they can contact you, and definitely should set up an appointment. I think, I've recommended people from all over the country to talk to you because you're definitely somebody I trust. I've known you for quite a while, and I have 100% confidence in the fact that you are a fiduciary and you actually take that seriously and are looking out for the best interests of the people you represent. So of that, I have no doubt, and so I have 100% confidence in recommending you to everybody that I know, because especially like right now with all the uncertainty, there's so many options and opportunities to really grow your money. And a lot of people are scared and sitting on the sidelines saying, "Oh, I only got a 2% interest rate," but I mean, you can make so much more money by purchasing a nicer, bigger home and putting the rest of that equity over the 20% to actually work for you, as long as you can afford, your monthly payment. And I think it's very important that really they sit and talk to you. And so please give out your contact information and let's fill up your books.
Jason, thank you so much for having me on your podcast. One of the ways that you can get a hold of me is with my email address. It is B Lorenz, so B for Brandon, Lorenz, Lorenz, at cedrusfinancial.com. Cedrus is Cedrus financial.com. A lot of people like to say Cedrus. But there's actually a little bar above the E to make it a long E. So cedrusfinancial.com. And, that's probably the best way. I'm sure, Jixon, you can pass on my email and contact information as well. But Jixon, thank you so much for having me on. It's been a wonderful time. It's always wonderful to talk with you and to, do a little bit of education.
Yeah, thank you so much. Yeah, because these are the questions that keep coming up, it seems like on a daily basis. So, I figured if we can record the podcast and get it out there where somebody can just refer right to it, it'll be a little bit easier to have that conversation. Say like, hey, check out the podcast instead of well, let me tell you about this. So thank you for your time and coming on. And wish you have a good weekend and we will catch up later. Thanks everybody.